Hello, everyone, and welcome to Real Property Pros and Cons episode 2. That means that I've survived my first episode, and I will be here for a second episode to talk to you about what's going on in the world of real property and help you find the pros and avoid the cons. So, right now, why don't we just get started and talk about what's new and noteworthy in the world of real estate? All right. Well, starting with a first story from San Diego. Unfortunately, if you're not from San Diego, this doesn't really apply to you. The city of Santee, which is in San Diego County, has decided to pull a new housing project that was supposed to add approximately 3,000 units to the housing market because of a judge's ruling that the housing development would not allow for the residents to leave if there were a fire. Now, as many of you know, from watching the news or reading the newspaper or listening to podcasts, San Diego has a really serious wildfire problem, as does the rest of the state of California. And many people lost homes, had homes threatened, or lost lives as a result of many different wildfires. And so what was really interesting about this story is that now housing developers need to add one more thing to their list of what we need to worry about before we build a new housing development. Specifically, are the people who live here going to be able to escape in case of a wildfire? And that's really important because we don't want people to live in really dangerous locations. The thing that comes to mind is the people who built a development underneath an active volcano in Hawaii a couple of years ago and then had to, evacuate because the active volcano did what active volcanoes do, which is erupt. And after it erupted, they all lost their homes and many of them didn't have insurance coverage for volcanoes erupting and destroying their homes. But really, what one of the articles that I read at that time said was, with housing affordability going down and people needing to find places to live, people are building their homes in riskier and riskier places. Now, of course, building a home in a place where there's a risk of wildfire is probably not the same level of risk as building it underneath an active volcano. However, that's really an important consideration. And now the judiciary is stepping in and saying, okay, well, you know what? If people are concerned about this risk, we're not going to allow you to build here. Uh, just out of sort of for some background information, the people who challenged that particular development project did so more than likely under the California Environmental Quality Act, or CEQA. And they essentially said there's going to be negative environmental impacts if you build here, and you haven't properly accounted for them or mitigated them. And the judge agreed. And also, another really interesting fact about the story is that part of the judge's ruling and part of the reason why the judge ruled the way she did was because there was a potential extension of a route that would allow the people to exit in the event of a wildfire, and that expansion was not approved or was denied or delayed or something along those lines. And the judge said, well, now we've cut off one of their escape routes. So on some level, what that means is everybody is trying to make sure that even though there's a lack of housing inventory, we are putting people in places where will safely be able to escape in the case of any um, any risks. So this was in the San Diego Union Tribune. Second story from Fortune, which actually came out today, which is June 2nd, is even rich people are living paycheck to paycheck. Now, that's really, on some level, not super surprising just because of inflation and the fact that costs are going up. And rich people have higher expenses. But what was really interesting about this article from Fortune magazine is that 61.3% of all Americans are living paycheck to paycheck, and a third of the people who earn an income of over $250,000 a year are also living paycheck to paycheck. So to give you some idea of what that means, over $250,000 a year means you're making over $20,000 a month gross income. So that means that even people making that much money are essentially saying, well, I need to make sure that if I do not get my next paycheck, I will not be able to pay my bills. Of course, that represents 5 times the national average income. So the average income is approximately $50,000 a year. So $250,000 a year is 5 times the national average. So really, what does that mean? I guess that on some level means if those people are having issues sort of saving money, basically, then what are people who are making less money doing? Now, some interesting things came out of this article. The first really interesting thing was that people who are making over $250,000 a year or making $250,000 a year are not struggling to pay their bills. Only about 10 to 12% of those people are really struggling to pay their bills. Everybody else, it's just that I need my next paycheck in order to pay all of my bills. And only 48% of the people who are living paycheck to paycheck have made credit card payments in the past month, as opposed to approximately 90% of people who have are making over $250,000 a year. So this was a report from Lending Club, and it was issued in April. And one of the interesting things about this particular report is that this is the first time that it reported any statistics related to people who earn $250,000 a year or are generally high earners. They usually just looked at people who are making the median income or below. So really what that tells us is we really don't know if this is a change in the statistics, or if this is just kind of a statistics that's been true for a really long time and everybody isn't noticing it only now. Who knows? Regardless, it's really important to understand that this is the case, especially in the world today where we have a lot of issues with affordability, inflation, increasing gas prices, and also increasing housing prices. And also, interestingly, people who are high earners are the ones who are able to afford houses, and houses are more expensive. So generally speaking, you're going to be paying more in a mortgage than you would be for in rent. And so that means, well, these people are buying houses and need their next paycheck in order to afford their houses. So that's good to know. Last one related to our guest today is that 72% of homeowners don't understand essential home insurance coverage. And this is a May 31st article from Forbes. And they had some really interesting statistics that I'm going to put up on the screen because I found them really surprising. So, first statistic, and I'm just going to make this ticker go away. First statistic is that 39% of homeowners do not know home insurance covers dog bite incidents. So, people who have homeowners insurance, 39, almost 40% of them, that is more than a third, do not know that home insurance covers dog bite incidents. A lot of homeowners insurance has overlays or riders basically saying, yeah, well, we're not going to allow certain breeds. Most common breeds are German Shepherds, Pit Bulls, Doberman Pinschers, and Rottweilers. So if you have those kinds of dogs and they bite somebody, a lot of times home insurance will not cover them. But other than that, if you have a friendly lab or a golden retriever and it bites somebody, most of the time, homeowners insurance will cover that. Second statistic is that 71% of homeowners believed that home insurance covers damage to a vehicle. That is not the case. homeowners insurance does not cover damage to a vehicle. Your vehicle insurance covers damage to your vehicle. So that means that if there's a fire and your car is left inside the house, your homeowner's insurance is not, unless you get a specific type of policy, is not going to cover damage to the car. Another statistic is that 40% believed that earthquake damage is covered by a standard home insurance policy, which is also not the case. In California, for instance, or really anywhere, earthquake damage is not covered by a standard homeowner's insurance policy. You need to get additional earthquake insurance. That means that if there's an earthquake and your house gets destroyed because of it, even if you have a homeowner's insurance policy, it will not be covered unless you have supplemental insurance. Now, what was really interesting about this statistic, which I didn't put up on the slide, is that a third of people who lived on the West Coast thought that earthquakes were covered by a standard policy because on the West Coast, which is where I am, we have a lot of people who care about earthquakes, right? There's like a lot of nice big fault lines, and then the fault lines cause earthquakes on the West Coast. So people who are at greatest risk, a third of them thought that it was covered by a standard policy. And then on the East Coast, a third of the people who lived on the East Coast believed that flood damage was covered by a standard policy, which it's not. You need to get flood insurance. So that means that you should actually find out what your insurance covers. And the last one is that 61% of homeowners believed that a standard homeowners insurance policy does not cover wildfire damage. And when we bring on our guest, we will talk a little bit more about whether or not standard home insurance policies in California cover wildfire damage. But as a general rule, if you get a homeowner's insurance policy outside of the state of California, more often than not, it will actually cover wildfire damage. So that means that our wonderful guest who will come on our next segment will talk to us about homeowners insurance and everything that we need to know about it to be responsible homeowners. Hello. Well, I will make you the star of the show temporarily. Thank you so much for being with us. Fergal Cullen is my guest today. Fergal Cullen, you wouldn't know this yet, but you'll know this once he opens his mouth and starts talking. Fergal was born in Ireland and has worked and traveled across the world before relocating it to San Diego in 2006. He enjoys spending time with his wife. He enjoys travel and sports. Before he became an insurance a sales producer, he's had jobs in social care, in the community, in fitness and sports development, as well as sales. Currently, Fergal works as a sales producer at the J.P. Hayes Farmers Insurance Agency in Carlsbad. I bet you have a really nice office and a really nice view up there. He joined the agency in 2020, and the agency is now in the top 1% of farmers agencies in the country, and it achieved the President's Award. It became part of the President's Award Council in 2021, which was last year. J.P. Hayes, as well as Fergal, offers home, auto, and commercial insurance, and he is licensed to write business and insurance in California, Arizona, and Texas. So, Fergal, I want to say thank you so much for being with us today.
Thank you, Franz. Pleasure. Thank you for taking the opportunity to welcome me here. Appreciate it.
Yeah. So, you and I have kind of known each other for a little while, and I guess guess the first question that I do have for you is, what should people care about when it comes to homeowners insurance, and what should people know about their homeowners insurance policy? Because if we just look at the statistics that I put up, a minute or two ago, it seems like people really, more than half of people who have homeowners insurance don't understand what it covers.
Yeah, those those statistics you put up, it can be kind of scary, especially when the earthquake and the fire, if they don't know that their policy doesn't cover earthquake, there's an earthquake and their home is destroyed, that's a major, major catastrophe. And yeah, this is why a great agent, great agency behind you is so important. So, like, first of all, like a homeowner's policy, it's going to cover like things like fire, smoke damage, lightning, theft, falling objects, water damage. But most of everything has to be kind of sudden and unexpected. So it's not going to cover things like wear and tear. So, like your 1960 home, you haven't replaced the piping, they're gone all bit wear and tear on them, it's not going to cover it. So if you have a leak there, it's difficult to get into claims because every claim is different, but just if it's sudden and unexpected, then the insurance, that's what your insurance is there for. With the earthquake, that's a huge one, especially in California.
Yes, especially in Southern California.
So, like, we never know when there's going to be an earthquake. There hasn't been a major one in a little while, but we just never know. The great thing about getting earthquake insurance is it will give a discount on your home policy. If you bundle your auto, you'll get a discount on that as well. Plus, by bundling your auto with your home, you're going to get, like, without us and farmers, you're going to get a 20% discount on the home, 20% discount on the auto, plus a discount with having an earthquake. So, like, it's going to eat up much of the cost of earthquake policy. So it's really an inexpensive thing when you look at it like that, and it's really important. The other statistic you put up about the fires, wildfires, that's an interesting one here in California.
Yeah.
And what you were going through with all the builders building in these locations as well. You know, it's for a lot of homeowners, they don't realize they might buy a home in an area, they wouldn't have no idea, and it's not their fault that it could be in a wildfire zone. So there's different wildfire codes, depending which one you're in. It could mean that a carrier will not cover the fire side of it. So it'll cover all the other perils, like I mentioned, water damage, say roof damage, things like that, but it won't cover any fire damage to the home. That's where you have to get this separate policy, and it's called a California Fire Plan. And
So is that just for California, or I mean, it's called the California Fair Plan. It sounds like it's for California.
Yeah,
but is that really a California thing, or does that exist in, say, Arizona, Texas, or other places?
Yeah, so like, well, in Texas and like there's a lot of flooding there as well. So like people have floods here. So flooding is another separate policy that's not covered under the homeowners. So if there's like wildfire, it just depends on the carrier. Like, for example, if one carrier here in California they may not cover a home in a wildfire area. However, farmers, we could cover it. So it just depends in each state. You have to shop the market because the fair plan has to be the last resort.
Mm-hmm.
It's like your final go-to. You have to exhaust all the other avenues. So if you're in
the fair plan, it's like it's fair, but that means that it's like, not going to be an extra mortgage on top of your mortgage, but it's still really expensive, right?
Yeah, like that's the thing. So this is where homeowners, when you're buying a home, I'm like I'm so open. You can give me a call if you're looking to buy a home in a certain area. I'll check it out. I can give you like an estimate of the home insurance, see if it does need a fair plan. It's a great way just to get an idea because it is scary. Some people, when they see that they have to get a insurance policy from the insurance carrier, then they have to go and get another separate policy, and the two policies could a lot of times be cost the same amount of money. So
Right. So you're doubling your premium.
yeah, so it's like you were saying, just be if people can get more educated, find a really good agent who's going to explain these things to you. Find a great realtor like yourself who can explain to clients as well, like what's going on, so they don't have that moment when it comes to buying insurance.
Yeah, exactly. And so I also wonder, when you're looking at something like the fair plan, are there some markers that might tell you, hey, your home is in a wildfire area? Like
Yeah,
if it's on a canyon, maybe, or if there's.
yeah, That's exactly it. But say like in San Diego, like you could live in a built-up area, but we've so many canyons here. You could be have a high, um, in a high fire line area. So even though your neighbor that's maybe half a mile up the road or less doesn't need a fur plan, but you're in this area where there's a lot of bush,
Hmm.
you're higher risk. You may need that fur plan. So yeah, there's certain things like that. If you're, for example, and the national parks, say like, for example, one big one, Big Bear. That's you're got probably going to need a fur plan if you've got a home there. A lot of clients I have, they've got a secondary home there. A
Yeah.
lot of them need a fur plan on top of their insurance for that one. In places like kind of when you go like East County, like up, we all know up in LA, so many fires around LA, Orange County. Um, all them guys will need most likely need fur plans in those areas in the hills, you know.
Right. And uh, is the fair plan affected by maybe people having to rebuild their homes like if their home burnt down as a result of a wildfire, does that kind of make it an automatic fair plan situation or not necessarily?
Yeah, so like once you get that fur plan coverage, it's going to cover the home. Just say it did burn down, it will cover the
Right.
home. So you're going to have that reconstruction cost, dwelling coverage A on that fur plan, and that's going to cover the rebuild cost. There's extra endorsements you can add in as well, like debris removal. That's a really important one as well. So like you wouldn't believe the amount of money it costs to actually remove the debris from that location.
So like if your house burns down, removing all of the
Yeah,
basically burnt down stuff so
yeah,
that you can build a new house on top of it.
yeah, and
uh,
that all adds up pretty quickly. So that's a
right.
separate endorsement you'll definitely want to add on to that. Even on your own homeowner's insurance, there's like coverage built into the homeowner's policy to cover that as well.
I mean, I often like to think about an insurance policy as, you know, somebody else saying, okay, if this happens, I'm going to pay you money unless this is true or this is true or this is true. Like the pages and pages and pages that you have in an insurance policy are all of the unless this is true parts.
Yeah,
As opposed to like they've agreed to pay you the money and we're good on that part. And then they
Mhm.
add a bunch of stuff basically saying this is stuff unless this. So basically what you're talking about with the debris removal, it's like we agree to rebuild your house provided that it is a clean, fully buildable, clear lot. And if it's not that, then you're going to have to pay money to get rid of it.
Yeah, and that's like sometimes insurance companies get a bad rap, but like every situation, every claim is different. Every carrier, how they handle their claims is different as well. It's always good, a great idea, like those numbers you pointed out at the start, like homeowners thinking they had all those coverages already, like for earthquake and stuff. Like if you have a good agent, you're gonna know that in it before you even buy the policy. Because the way I do a homeowner's policy with my clients is I go through everything with them. They fully understand what's like any questions they have. I straight up let them know about earthquake. It's a separate legally we have to let them know that it isn't included in a homeowner's policy in the standard. But also there's a lot of other add-ons you can include in a homeowner's policy that kind of people, okay, they kind of cost a little bit extra, but that cost, if something happens, is doesn't mean anything. It's meaningless because if something happens, at least you have that coverage, and it's in those moments where you go, "Oh, I wish I didn't decline that endorsement."
It's
You know,
usually the one, it's usually the one that you decline that you end up needing.
exactly. Like for example, like Farmers has a great one for auto insurance, like windshield protection, so glass deductible buyback. You're driving down the road, a rock flies up, smashes your windscreen. We'll replace that for like $100 if you have this coverage on it. Other insurance companies, you might have to pay your deductible if you have comprehensive, maybe $500 or $1,000, whatever the case may be. And if
Right.
you're driving like, I don't know, you know those Teslas now, so windshield replacing, like $1,000 or more maybe. So that's
Yeah. And I remember, it's like that actually happened to me. There was like a crack in my windshield, and I called to find out if it was replaced, how much it would cost to replace, and they're like, "Oh, the windshield is like I don't know, $200 or whatever." And I was like, "Okay, that's not that bad." And they're
yeah,
like, "Oh, do you have like lane keep assist? Do you have adaptive cruise control?" And I'm like, "Yeah." And they're like, "Oh, well, that's housed in your windshield too." And like that's an extra, I don't know, $500 to do that, and then an extra $500 for the calibration, and
yeah,
you got like $1,200 to replace your windshield. And I
yeah.
was like, oh, that's not great.
So yeah, that's like part of our agency, and that's one of the main reasons why we've achieved this President's the Council Award is because we do our due diligence. We make sure that we cover the home correctly. We offer all the endorsements, so we'll explain them, and I make a purpose of emailing my prospective client the endorsements, what they're about, what they cover, so they're informed, they're educated, and they know they're making those informed choices.
Right. So I wonder, at least as it relates to homeowners insurance policy, what are some things that homeowners really should think about when they are getting, when they're buying a homeowners insurance policy?
Yeah.
And I mean, I think that like a lot of homeowners, they're shopping on price,
Hmm.
which is fine because you've dropped, average price of a home in San Diego is 860, I think now, and some change, and 20% down, you're at $172,000 plus, all closing costs, you're at like 200 grand, right? And
Hmm.
it's like, okay, well, do you really want to be paying an extra $7 or $8 a month but like, what should homeowners really be thinking about?
Yeah, like that's when you explain it like that, and if you're a homeowner, you write that down. Right, I'm investing $800,000 of my money into this home. What really then compare that $800,000 to a couple of $1,000 on an insurance policy, which is going to protect that investment, all your hard work, everything you've put in, going through the process of buying the home, trying to outbid some other about 10, 20 other people or whatever it is. You've gone through all this stress. You got your dream home. you're in there, you're loving life there, and then suddenly something happens, and you look at your insurance. You wanted to save a few dollars, and then you don't have coverage on that policy. You're going to be out of pocket for
Right.
thousands of dollars. So what you have to weigh things up and kind of take a step back. What like a good agent will tell you exactly what to put into that policy to include, like those endorsements, such as like sewer and drain backup. So like on a standard policy, any floodings from sewer and drain, some pumps, it's not covered under those uh,
Mm,
policies. You can add that in for like, depending on the home, it could be like $80 extra, $100.
for the year.
Yeah,
And I'm
and
curious. I'm curious. It's great to like pass the risk onto the insurance company, but I am kind of curious, like, to what extent does uh making a claim on your insurance policy really affect you? Because, like,
yeah,
a clogged drain it might cost like $5,000 to fix.
hmm
Um, but if you make a claim on your insurance policy as opposed to paying for it out of pocket, what are the considerations there?
yeah. It's great that you brought this up. It's something that 99.9% of people I speak with have no idea about, and it's it's scary for a homeowner. So if you have a claim, two claims in a 5 year period, especially if one's a water claim, you can be dropped by your carrier. Um, then you have to go out shop around. For example, I had one. The most recent person I did with this situation, they made two water claims, and it was only like approximately, I think, $900 one claim was.
Oof.
Yeah, another one was like $1,500.
I want to know what policy they got that had a deductible that was lower than that,
Well,
but
actually, this is the thing. Their deductible was $1,000, so um, they were badly advised. um, but that person, their policy, if I remember correctly, I think they were paying $2,500 for the year
Mhm.
before those claims happened. They went to shop the market. They were getting quotes at five, six, $8,000.
Yeah,
So that's how high it can jump if you're badly advised. If you like the deductible is a big one. So what we always hear in our agency, we tell our clients is insurance is there for something that's going to ruin your life and not your day. Look,
right.
you know, like if something costs $1,500, look after yourself. Um, don't call it in. We prefer people have a higher deductible because that means like you're not going to make those small little claims and just save the insurance for the most important things. We never know what's around the corner. So in 6 months'
Right.
time, you could have a massive water burst pipe. It could ruin your whole flooring. It could 15, 20, $30,000 to do cleanup or whatever. Or else your home might burn down, you know.
Right.
So there are things that can more than ruin your day. Whereas
Yeah.
like something that happens to the roof, just you can look after yourself. Um, so our agency, we've got like our own service team. So our clients, they can call us and we'll advise them exactly how to approach all this. Give them and then during the claims process as well, we're always there supporting them, so they get that extra support from our agency and guidance. Which is a big. It can be stressful going through a claim.
Right.
Once you have a team behind you, it makes it a lot easier.
Yeah, definitely. That is having a good team behind you, having a team of pros, if you will, behind you is really helpful when you're trying to make these decisions.
Hmm.
Um, and I also am kind of curious, what take you might have. So, we looked at you heard the statistic that 61.3% of all people in the US are living paycheck to paycheck, and there's another statistic associated with that, which is that roughly that same percentage could not afford an unexpected $500 expense at any given time. And so I wonder, how what you think the interplay is between sort of people's lack of spending or people's lack of saving, people kind of living paycheck to paycheck, irrespective of how much money they make, as compared to, recognizing that owning a home or anything requires money, right?
Mm.
Like buying a house is expensive.
Yeah, totally. Like, I think every, from a personal point of view, and I think this is worldwide. Like, I went to school in Ireland, grew up in Ireland. We weren't taught about financial management in school. I'm sure over here in the States, it's exactly the same. From financial advisors I speak to, they say like the same thing. So having a good advisor, um, a financial advisor, but like when you're buying a home and you're living paycheck to paycheck, is it a really good idea to be buying a home? And you know, like you gotta put things in perspective. Like, say for example, you bought a home, you're living paycheck to paycheck, and then something happens to the home, and your policy, because you didn't have enough money from that paycheck to cover those endorsements you needed for the insurance, you're going to be out of pocket. So it's adding more stress to your life, unexpected costs. So you definitely want some financial advisor to help you manage your money. Um, but definitely, I think it should be taught in schools from a young age, and then we have a more respect for managing our money.
I definitely agree with that.
Yeah.
I am curious also, if you have any thoughts about how much money people should be saving if they're, you know, if they
Eh,
want to. Yeah, like what do you think the average deductible
oh yeah,
should be on an insurance claim, and that is how much money people should have if they plan on, owning a house and
yeah.
being
Like
able to pay.
well, I've seen policies where there's deductibles for $500, $1,000. We aim a little bit higher, 2,000, 2,500. Then 3,000 would be the next. So I've got clients who have deductibles at $10,000. Um, because they was interesting because one of the guys I insured is then a financial advisor. He has a deductible at $10,000. Um, one trick he told me, like if you set aside that deductible amount for those rainy days, so it's easily accessible, even if you're able to invest it in some way, and you can easily take that money out in case something happened. So like that's another great way by having a great financial advisor. You could do little things like that. So that deductible at that time, it's not a big deal. Same with your auto insurance. Like always have a little bit of spare cash, whether it's invested somewhere you can pull it out easily, and you have those to cover your costs. So
Right.
yeah,
And I assume that means then your insurance company is not paying those costs, and it's less like you said, it'll really be for something that's like serious.
yeah, exactly. Yeah, yeah. So like if you say something happened that cost $1,200, whatever, if you're able to pull that money out of somewhere where you've built it up, and maybe it's building extra money on top of that, Uh,
Hmm.
they pull that $1,200. There you go, and it's not a. It doesn't seem like a big deal, but at that time, it will make your life so much easier rather than scrambling around trying to find $1,200 from somewhere. Maybe asking friends or family for a loan. You want to kind of avoid that.
Yeah, yeah, you definitely want to avoid doing that and really just like saving some money
Hmm.
um when you can. And I'm also kind of curious, uh what do you see sort of in your industry? What do you see as kind of being the average claim amount? Like how much are people really uh pulling out when they have a claim?
Um, it can vary. Like the latest person, one of my clients, needs to get the roof replaced. Um, I think she said it was like going to cost about 15,000 to do those repairs.
Yeah, that sounds like a
Uh,
roof repair.
yeah. Like water damage, it varies. It could be as little as $300, or else it could be like I've seen claims. The highest one was $50,000.
Mm.
An average, the average amount for like a water could be like between 10 to 25,000.
And is water damage sort of one of the, death knells of insurance policies? I- Is it really just one of those things that insurance carriers really don't like?
Yeah, that's why it's so important to um maybe have those extra endorsements. There's another one like an inexpensive one you can also include like service line. Like with us, it's $25 for the whole year. It covers like the utility lines coming from your home out to the street, like all
Mm.
on the property that the city won't cover. So if
Hmm.
anything happens to them to do the excavation, all that kind of stuff, that's out of pocket unless you've got this coverage. Um, so, like with the water one, it's yeah, it's the one that we. If there's a claim coming into us, we're always kind of praying it's not a water. it's, it's not nice for the homeowner, you know. Uh,
Yeah, and I think insurance companies really don't like water claims for some reason.
yeah, yeah, and also because of the it's because of the damage it does, and
Hmm.
then like you might have mold after it, you know. Um,
Right.
And then for the homeowner, if it destroys all your carpets, your furniture, it's horrible.
Yeah, it is terrible, but at least the insurance company will typically cover
Yeah.
those things.
There's actually a great device you can get, like a water shut off. So like it'll monitor the water. Like here in Farmers, we work with a company and we can install that, get that installed in your home, and it'll shut off the water if it senses like any leaks or anything like that. It's a really good
Wow.
one to have. So, say you were out of town, went on vacation or whatever, or you just out for the night or whatever, and then there was a leak, and this sensor nipped it in the bud by turning off the water. It's a pretty that could save you a lot of money, but a lot of stress as well.
Yeah, definitely. Um, and I mean, we spent a lot of time talking about sort of houses and wildfires and earthquakes and all that sort of thing. But, I was reading another article that talked about how we're trying to move away from single family homes towards multifamily condos and stuff like that. So I'm curious if you have anything to add about condo insurance, and is it roughly the same for condo insurance, or is it different? And, what might homeowners want to think about before we answer a few viewer questions.
Yeah, that's a great one. So with condos, townhomes, the policies are slightly different. So we're kind of talking about walls in policies. So the HOA will have their master policy for all the properties or all the units. So that'll cover all the shell, the outside of the your condo. So that master policy, I'll actually talk about that one after. Your condo policy will cover everything from the walls in, so like the flooring, the fixtures, everything like that. With the master policy, this is where condo owners, townhome owners have to be really, really careful as well. A lot of times there's a coverage missing, and I found this with a lot of clients have come to me from other carriers or other insurance agents, and they're missing a coverage called loss assessment. What that does is, say the master policy, HOA master policy, is if something happened to the building, outside the building, or if there was, say, if there's a swimming pool in the community, say there was an accident there, and say the master policy either didn't have enough on it to cover the whole incident, or else they have a really high deductible, they'll go to the unit owners to contribute some money towards those out of policy costs. So that's where your loss assessments will come into play. So you can get coverage for like $10,000, $15,000, $25,000, up to $50,000, and it's so inexpensive. It's like it can be from like $9 up to maybe $18, $20 for all that coverage, and that will really protect you. Then, if something in that master policy didn't cover, the deductible is so high that they ask the unit owners to contribute to that. That's one thing to look out for. So what we offer is, if the client isn't sure about the HOA master policy, they can go to the HOA, get a copy of that. They can send it to me. We'll review it, and then we can put all those necessary coverages into that policy as well.
Awesome. Well, that's super helpful. And so let's move on to Ask the Pro, and we'll find out what some viewers are asking about what you talked about.
Actually, just before you go there, dog bites is a really interesting one.
Sure.
So make sure, if you have a dog, have that listed on your policy. There's a question in homeowners policies: are there any dogs? Have they ever bitten or attacked? So you got to make sure that you tell your agent that you have a dog, the breed, and it's listed there, because if something happened, it's not on the policy, there's a chance that claim could be denied. So, and dog bites are one of I think it's number one at the moment for claims on homeowners policies.
Oh, wow. Well, great. Well, hopefully a viewer didn't ask us, and let's go to Ask the Pro. All right, we've got a couple of questions. The first question is, can a homeowner's insurance premium affect how much of a mortgage I can qualify for?
So, like, with homeowners, like if you're buying a home, it's going to go through escrow. So, like, with those situations, I'll get in contact with the escrow officer, and then I send over the insurance proposal. They review it, and then we normally, like in our agency, we have everything spot on. So like with the coverages, as long as the policy is covering the home properly, it shouldn't be an issue for buying a home. Like the only thing would be, like I said earlier on, the cost of a policy. If the homeowner wasn't aware it would cost so much, especially if it's in a wildfire area, that's something on the homeowner then. Whether I've seen clients not buy homes because of the cost of the insurance.
Yeah, I've definitely seen that as well. And also, whenever I bring on a mortgage pro, we'll definitely talk about sort of principal, interest, tax, and insurance, but that is kind of what they look at. So hypothetically, if you've got a as Fergal, you mentioned sort of a situation where the insurance premium is double, especially, with people who are kind of on shoestrings figuring out what they can qualify for, then having to pay $4,000 a year as opposed to $2,000 a year for an insurance plan can and probably will affect your ability to qualify for the mortgage. So that is question one. Another question I that got is, oh yeah, well we use this terms a whole we use this term a lot. We really didn't define it. So what is an insurance endorsement?
So it's an add-on. So adding on whether it's the sewer and drain coverage, service line, equipment breakdown. So the equipment breakdown is a good one. Like if you've got like HVACs or anything like that, if that's was sudden and unexpected, it broke down. That's an add-on. That's an endorsement you can have that will cover those situations. Like there's many different like floaters as well. Like if you've got expensive jewelry, homeowners policies will only cover a certain amount. Same with computer electronics. So if you need to add on anything, you can add on a floater. You can add on all these different endorsements that will give you that extra peace of mind in case something ever did happen.
And so one of my friends has a very, very, very expensive piano. It's worth like maybe $200,000. So that
in the background.
What? Yes, maybe that could be the piano in the background. But that would probably be something that you would insure separate and apart from your homeowner's insurance policy.
Yeah, exactly. And you need to keep like a great thing. One piece of great advice would be take pictures. If there's serial numbers, especially on electrical equipment, keep receipts. If you've got like expensive jewelry, that piano, say for example, get it valued. So like in case something did happen, you've got all this evidence to give to the claims adjuster, and that makes their life so much easier. So they're not bugging you, calling you for like estimates, and make sure as well you save them in a safe place. Like save them on your, I don't know, like the cloud or something and then have a paper one, save it in a few different places so you can access it. Like it's really, really important. It'll make your life a lot easier going through that claims process.
Awesome. Thank you for that. And last but not least, one last question is, can a homeowner's insurance premium affect, oh wait, no, that I already answered. Do I have to get homeowner's insurance to buy a home?
So you don't. So say someone buys a home, you just pay cash or whatever. You didn't you don't need to buy insurance. It's not a legal thing, but just say you did buy a home, you splashed all that cash out on that home, and then a few days later the home burnt down, you've no insurance. You're going to be out of pocket for that $800,000.
Right.
So yeah, buy a home, buy insurance.
Yeah. And also, I've been reading, so there's a lot of different pieces that I've been reading about. One of them is, people are mortgaging their house, their primary residence, either pulling out the equity or, getting a line of credit, doing a HELOC, to do one of two things: buy a new home cash. That's one option. And the other option is they're doing it in order to help their kids buy homes. So their kids, grandkids, nieces, nephews, people who they feel are their children, but are not actually their children, whatever. So they're giving them this money and they're buying houses cash. And that's also a situation where it's technically a cash deal, but it's not really a cash deal because there's another property securing that property. And typically the lenders typically require that you get homeowners insurance. So if you have a mortgage, if you mortgage a property, then the lender says you have to insure the property so that we get paid if something happens.
Hmm.
But if you're using it to purchase another property cash, then if anything happens to that property, you're just out the money.
Yeah.
And so sophisticated investors, a lot of times, you think about people who are buying properties cash, and they're sophisticated investors who have a bunch of money and they can pay for it, or they have lines of credit or whatever, so
Hmm.
they can buy a house. But then if you have like sort of relatively less sophisticated people, or people with less experience, who are purchasing homes, quote unquote, cash, um, the escrow company is not going to tell you that you have to have insurance. The escrow company is just going to tell you you've got $1 million and there's the house, here's the title, everything seems okay, and they'll just trade it. And they're not going to tell you that you have to get insurance.
Yeah.
Um, so you really need to be aware of, if people are getting cash deals, they have to really be aware of what they're doing, so that they can make sure to insure their assets properly.
Hmm.
And we are almost out of time. So, do you have any last interesting pearls of wisdom for our viewers before we call it a night?
No, just really, if you want, or what you should do is look at your policy, contact your agent just to review it. If by chance your agent isn't available, or um, I'm more than happy to take a look at any review someone's policy. It's totally no obligation. Just review it. I can give you advice, see if there's any gaps on it, and yeah, you can go back to your insurance agent and see see about getting those gaps filled. But that's something I love doing that, because at least then some people walk away, they're more informed, and it kind of they're going back to their agent and kind of, what's the word, maybe like
I think the word you're looking for is negotiating.
yeah, but we're like, oh, just making sure that they have a policy that's going to cover them
Right.
in an unexpected situation. And that's, no one wants to be in a sticky moment. Something happens and their policy doesn't cover it. They're going to be angry with their agent. They're going to be angry with that insurance company, and no one wants that, and they don't want the stress of it.
Exactly. Well, thank you so much for being with us. And next week, I will be back with another real estate pro. And I hope you all have a great night.
Thanks.
Bye.
Thank you.
Bye.